this could signal that investors really are looking beyond Greece and that there is more confidence at this stage that there won't be any lasting impact. And the second thing it could signal is that conviction is very light and that traders are unwilling to hold on to positions for any length of time. I think the truth is much closer to the second, and I think that means that we will see renewed pressure on euro in the days ahead. I think that makes trades like short euro sterling, short euro yen attractive at these levels, anticipating that we are going to see a bit more contagion, a bit deterioration in sentiment in response to the deepening crisis.
Flesh that out. What's it going to look like? We're talking default, Greece, right? Are we talking Brexit?
I think the immediate focus, of course, is on the payment to the IMF today. All indications are that that's not going to be made unless there is a real surprise at this stage. And I think that that places the ball back in the court of Europe. We're going to have to see how the European institutions respond. This is going to see a lot of head-run risk in both directions until we get to that referendum over the weekend.
Interesting. Okay. Oh, come in on this.
Okay. What do you make of the rest of the activity that we're seeing in the FX markets at the moment? Because, you know, you would expect to see volatility in the euro, given what we're talking about, right? You would expect to see that. But we're also seeing quite a lot of downside in probably other areas, which is not necessarily expected, like the Aussie dollar, for example.
You know, to be honest, I've been a bit surprised that we haven't seen more of a response in other currencies, because I think that, you know, as I said, we're going to see headlines back and forth, a lot of volatility in euro over the next several days. That could see a bit of back and forth directionally, but that volatility is an unambiguous negative for other currencies because it's going to force investors to cut their exposure, to reduce risk. We had seen some moves out of the dollar and into currencies like Aussie over the past several weeks, and I think that leaves it vulnerable. We do have Governor Stevens speaking in London today. I wouldn't be surprised if he sticks to a dovish tone. I think that because of that positioning, because of the volatility that we're starting to see in other currencies and other asset classes, that there will be much more vulnerability to any effort to talk the currency down.
Well, he's pretty happy right now. I mean, we're down at 76, 60 something, you know, for the Aussie dollar. We're much closer to his target than we were, you know, even just a month ago.
I'm not sure they're ready to break out the champagne as of yet. I think he'd like to see the Aussie continue to trade lower, but you're right to say that we are within the ranges that we have seen recently. But I think there's an argument to be made that given the weak underlying conditions in Australia, there is still benefit to trying to talk Aussie lower. The costs of doing that are very low, so that means that he may try to keep the pressure on.
What about the Kiwi dollar? How does that sound? I mean, you were telling us that you were in the office at 2:30 yesterday watching the Kiwi market open. There must be a little bit of concern there.
You know, I think Kiwi had its moment in the sun over the past few weeks where we saw a huge degree of investor focus relative to what we've seen in the past. I think that moment has passed. You know, we're looking at much bigger issues with Europe and Greece. We're not hearing a lot of discussion on New Zealand. I do think that following the, you know, selling pressure that we've seen on Kiwi over the past several weeks, and in particular the up move in Aussie Kiwi, that is starting to look a bit overextended, but I don't see a New Zealand specific catalyst to turn that around for the time being.
Back to Greece. Default, Brexit, Fed holds off until 2016?
You know, I think that in terms of the pass-through...
Dollar run stops?
In terms of the pass-through to, you know, broader monetary policy decisions, it's obvious that there's very direct pass-through to places like Switzerland, where we will need to see more intervention. It's possible that the market will price in rate cuts from Switzerland, but I think that the pass-through to other countries, the UK, the US, that investors risk overestimating the degree of impact. Certainly it is an excuse for the Fed to express some concern and continue to sound dovish, but if we do see a pickup in terms of U.S. data moving forward, I still think that we are going to need to see them start sooner rather than later. Our call is that we see September.